Well, the debt ceiling has been raised, but lawmakers still must search for more than $1 trillion in new deficit cuts. Our next guest says that's not much clarity for the markets. Patrick Daugherty heads Highland Capital Management's distressed and private equity group. He manages $8 billion of the firm's $23 billion in assets. He's also a board member of several companies, including Paper Mills, Metro Goldwyn Mayer, MGM Studios, as you know, and Cornerstone Healthcare Group. Welcome to the show, Patrick.
Well, thank you. Thank you for having me. And by the way, this is my favorite show.
Oh, well, thank you. Thank you. Take that, Stephen Colbert. But in the meantime, I want to ask you, people talk to me all the time about opportunities in alternatives. I mean, give me something outside of equities that's going to give me safe, or at least a safer version of risk that's going to return me real money. And these low interest rates have pushed more and more opportunities towards your space.
Sure. And let's differentiate between par investing and stress and distress. On the par side, you've had the average performing senior secured levered loan trade down from the mid 97s to 95. So that carries a coupon of LIBOR plus 375, 400. It's got a nice inflation hedge to it because it floats. And so that's a nice, safe place to park your money, especially when you're talking about comparing it to the treasuries or a money market yield that's got 25 basis points.
Right.
If you want to take more risk, we always believe that there's a constant opportunity set in the middle market, especially for distressed and stressed investing.
What's middle market for you?
We actually define it by revenues. Revenues between $200 million and $2 billion. Some people define it by market cap, some people define it by cash flow, but we think that's the sweet spot for middle market investing.
And this is, I mean, to clarify, this is to own part of the debt of a company rather than, say, buying its shares outright, buying a stake in it.
Sure. Well, we look at it kind of three ways. You buy the debt at a distressed level, and let's call it 60, 70 cents on the dollar. If it goes back to par, you've had a nice return, and you've collected a coupon in between. If it doesn't, then you're willing to own the company through that fulcrum security, as we define it, such that you can have a nice 25% per year equity return in the long run, if it doesn't work out.
Now, people who work in liquidation in the consumer space say to me, I'm starting to get calls from lenders asking about movie theaters, asking about restaurants, and whether those kind of companies are going to be able to stay afloat, avoid bankruptcy. Where are we in the consumer debt space right now?
The consumer debt, it depends on who you are and where you're located. I would tell you that a lot of it depends on what your capital structure is. If you're generating the cash flows that can support it, you're fine. If you've over-levered and you're experiencing some type of exogenous shock or something that's driven by the markets, you're going to have your issues and you're going to become fodder for a distressed investor.
So it's not as clear as that, just movie theaters and restaurants. You're not looking there, but you are looking for opportunities in healthcare in particular right now.
That's right. Well, you've heard a lot of talk about balancing the budget and whether they actually get around to doing that or not. They've already started to make cuts in Medicare.
To hospitals, actually.
Hospitals, long-term acute care, skilled nursing facilities, even inpatient rehab. And home care, too, for that matter. So it runs the gamut. A lot of those industries and players within those industries have withstood significant cuts, and they've become stressed. And a lot of mom-and-pop operators are exiting those companies for fear of what might happen next.
Now, can you give us anything more specific than a sector here?
As far as a name?
Yes.
Since we're on the acquisition front, I'd rather not go in that direction.
It's a little uncomfortable for you to do that. You also like building materials.
Yeah, I do. That's a sector that's been brutalized over the last 3 to 4 years. In fact, many of those companies are still generating negative cash flow or break-even cash flow. That said, for the longer-term mindset, the cyclical play, we think it makes a lot of sense, especially if you can buy bank debt in the 60, 70 cent context.
Now, we had seen some distressed funds like yours start to consider municipal debt, the debts of cities and states, as distressed almost at this point. And there had been a lot of predictions about a wave of bankruptcies to come. We haven't yet seen that, though. We look at Jefferson County, Alabama, still having problems, some problems still out in California. Are you finding opportunities in this space?
It's funny. We never really thought the municipal opportunity was very real to begin with.
And you didn't think they were distressed?
No, you're going to have pockets where, like Jefferson County, for example. But for the most part, people underestimate the ability of these localities to cut costs and raise revenues, and that's exactly what they've done to at least stabilize themselves. And
from your perspective, U.S. credit, U.S. debt, not distressed.
Yeah, from the U.S. government, no. I think the market has spoken clearly.
All right. Patrick, thank you very much.